Welcome to This Is Money podcast, sponsored by Charles Stanley Direct. I'm Georgie Frost, and joining me and Simon Lambert today is Lee Boyce. And coming up, a certain US president has been hijacking all of the headlines in recent weeks, but what do Donald Trump's antics mean for UK investors? Meanwhile, one of the UK's biggest investment firms, Vanguard, has spurned the Chancellor's efforts to drive up investment in the UK as it plans to cut its LifeStrategy exposure to the UK. Why and what should you do? Also today, Nationwide bumps up what it'll lend on mortgages to 6 times salary, how much you need to have saved in your pension at every age for a stellar retirement, and would you spend £5,000 on a smartphone? Don't forget to stay up to date with all the latest breaking money news. Just go to thisismoney.co.uk or download the app. But first, a message from our sponsors. Do you love talking about money as much as listening to it? Then you'll love this. Charles Stanley Direct's financial coaching service gives you a real human, yes, an actual expert to help you make sense of your finances. No jargon, no pressure, just clear answers to your money questions. Book your free 50-minute call today at charles-stanley.co.uk/financial coaching. Go on, your future self will thank you. Remember, investment involves risk. Now back to the show. This is, as we always say, a financial, not a political podcast. So we will leave that part of this discussion to the experts on other pods, but the antics of Donald Trump over recent weeks aren't restricted to Venezuela or Greenland or the US. The tanking dollar is bad news for UK investors with money tied up in US and global funds, which will be many of us. So what should we do? Welcome to you, Lee. Welcome to you, Simon. Simon, firstly, what is happening to the dollar and markets in general at the moment? This is a big question, I appreciate. There's a lot going on. As a result of the president's latest pronouncements.
Well, the overall picture, and you need to zoom out to look at the overall picture, is that the dollar has fallen substantially against the pound over the last year. The reason why the dollar has fallen substantially against the pound in the last year is the dollar has given up some of its strength. The bigger picture, if you zoom out, is that the dollar was particularly strong before this happened. Donald Trump has come in as president, and one of the things that he has identified as a problem for America, on his long list of things that he has identified as a problem for America, is that the dollar is too strong. Now, he hasn't explicitly said that he is indulging in policies to weaken the dollar, but his policies are weakening the dollar. And some of those involve a slight lack of faith over the interest rate policy of the Federal Reserve and how independent it is. Donald Trump has launched a number of attacks on the Fed and Jerome Powell, who is the chair of the Fed, saying that it should have cut interest rates by more. So you're seeing a lot of political pressure on the Fed to cut rates. Jerome Powell is due to, leave his role at the Fed soon. And there is a suspicion that Donald Trump is going to put someone in charge of the Fed who is more of a yes man. On top of that, you've seen recently, since the start of the year, Jerome Powell, a criminal investigation into him due to an overrun on spending on improving the Federal Reserve buildings, the cost of which, I can't remember the exact figure, but is absolutely astonishing. However, I find that the cost of many things is absolutely astonishing nowadays, so I find it very difficult to ascertain whether this is a fair cost or not. Added to this, we've seen, the saber rattling over Greenland, the abduction and arrest of Maduro in Venezuela, and various other things. And you're also seeing governments around the world shift some of their reserves away from the dollar and into other things such as gold, which is up substantially, because effectively the US government, in a sense, can control what happens with dollars, whereas it can't control what happens with gold or reserves held in other currencies. Now, this isn't to say that the dollar is dead. The dollar is not going to suddenly stop being, the world's number one currency and the one that people go to for reserves. But because so much money gets parked in dollars and so much money gets parked in US treasuries, it doesn't take a colossal shift away from it to start making a big difference elsewhere. And effectively, what we've seen over the last year is just less demand for dollar-denominated assets, which means that the price of the dollar against other currencies has fallen.
Just briefly, because we've heard this not just with the US, but with other countries as well. What's the problem with a strong currency?
Well, the problem with a strong currency is that effectively it makes your exports more expensive for other countries to buy, and it makes your imports cheaper. Donald Trump has done something to try to make imports more expensive with the addition of tariffs. The tariffs, effectively raise tax for the US, so we're actually boosting the US's income. The end result is that if you are a consumer in the US or a business in the US, then you are going to end up paying more for those imports. Mm-hmm. And Donald Trump feels that the strength of the dollar means that there is not a level playing field between the US and other countries, and it means that the US is too prone to buy from overseas rather than buying from, American made.
And where this, to come full circle, impacts on UK investors is we're a lot more exposed to the US than probably a lot of people realise as individuals.
So the greatest example is if you hold a global tracker fund. If you hold a global tracker fund that's based on the MSCI World Index, then more than 70% of that is going to be in US shares. This is down to the outperformance of very large US companies, particularly the tech giants, over the last 5 years or more, and this has led to an increasing level of concentration within that global index and also within the US index itself. The S&P 500, for example, is more dependent on those kinds of stocks. Now, all things being equal, this has been great news for those investors because they have made lots and lots of money. However, there's quite a stark figure in Tanya's story here, which illustrates the effect of the dollar's decline. The S&P 500 rose by 16.4% last year. That's just share price rise, it doesn't include dividends. And that's in US dollars. But once currency losses were factored in, UK investors received a much lower return of 8.4%. The MSCI World Index was up 19.5% in US dollars, but UK investors got a return of 11.3% in pounds. Now, if you compare that to the 21.5% return from the FTSE 100, that's just the share price return, UK investors will have got all of that because it's in their own currency. Now that's, if you've got an S&P 500 tracker, the first one, if you've got a global tracker, the second one, versus if you're holding a fund that just has UK shares in it. But many people will also hold, large global funds. And we talked about this last week, for example, when we were talking about Fundsmith. And if you've got Fundsmith, although that doesn't track the index, it's still got a very large amount of its assets in US stocks. The thing is, in most years, this won't make a big difference to you because currencies don't tend to move around by that much. But at the moment, this year, although those returns are very, very respectable, it does mean that investors, in those funds have received a much lower return than they thought they would.
How can we avoid the fallout? Is there anything we can do?
Well, you could only invest in UK assets, but then what you're doing is you are being extremely heavily reliant on the UK. You are moving very, very far away from, the kind of the balance that is the global market. And what you probably would have suffered over the last 5 years is massive underperformance compared to the global index or compared to the S&P 500. So that's probably not the right thing to do. You could put some more of your assets into UK assets. We're going to talk about this in a minute when we talk about Vanguard and its LifeStrategy funds. Alternatively, you can opt for hedging, which is something that seeks to remove the effect of currency movements. And you can buy hedged funds, for example. These are different to hedge funds, but a currency hedged fund will basically try to remove that effect from it. But what you might find is that, yes, you solve the problem in a year like this year and you don't underperform by as much. You'll still underperform by a bit due to the cost of the hedging and things like that. But then in the years when it goes in the opposite direction, so you've got to remember that in the years before the dollar was weakening, there were years in which the dollar was strengthening. And in those years when the dollar was strengthening, it was helping out UK investors. And then the other alternative is to potentially look to other markets as well. So you might not want to go all in on the UK, but you might decide that actually you think that the weighting to the US is far too high in your portfolio, and you want to stray from that, totally passive weighting in your portfolio, and you might go, okay, well, I'm going to put a bit more of my money into something like Europe or Japan or emerging markets. But then what you're doing is you're making an active decision that you know better than the market, and you are risking the fact that you are wrong.
Yeah. Japan's having a few issues as well, I understand at the minute. But are you seeing that? Are we seeing that? People move away from America, or is it just kind of holding tight?
We're seeing a shift away from it anyway. You can see that in the rise in the FTSE 100 over the last year, how much it outperformed the US market. Because if you look at the makeup of global stock markets, Nvidia, the world's largest company, is the same size as the entire UK stock market. So, it doesn't take much of a shift away from some of those big companies to other markets to push those other markets up. It doesn't mean that nobody's going to buy Nvidia shares anymore. It doesn't mean nobody's going to buy Microsoft shares anymore. It doesn't mean nobody's going to buy the S&P 500 anymore. But even just a small shift away from that, and the amount of money that flows into US stocks and into European stocks, into UK stocks, into Japanese stocks, or into other assets, into gold, for example, even into government bonds, only a small shift away from that can actually make quite a big difference. And there was some really interesting figures out last week, actually, talking about UK gilts and the fact that actually the interest from ordinary investors in UK gilts has been to such an extent over the last year or so that they think it's actually slightly reducing UK borrowing costs, which is really quite unusual.
Well, there you go. Right, Lee, Simon spoke about Vanguard and UK investing, and that we'd talk about it a bit more, because in a blow to the Chancellor's efforts to get us to invest more in the UK, one of the world's biggest fund managers has cut exposure to homegrown stocks of some of its popular funds. So Vanguard is ditching UK equities worth around £1.85 billion from the LifeStrategy range to reflect what it calls the more global focus of UK investors. It will also cut the fees on the range from 0.22 to 0.2%. Lee, what is the significance of this? Firstly, I mean, Vanguard is a very famous name, but just remind us, who they?
Yeah, Vanguard's a big US company. It's kind of shaken up a little bit the investing market in the UK with its low cost kind of funds and things. It kind of makes it quite easy to get involved. It's a very good place for novices to start investing. LifeStrategy is one of its sort of flagship products, really synonymous with Vanguard. There's 5 different LifeStrategy funds. There's 100, 80, 60, 40, 20. LifeStrategy 100 is 100% equities. LifeStrategy 80 is 80% equities, 20% bonds, so on and so forth. It's pretty big news, this, because there's a lot of money that is in the LifeStrategy funds. More than £50 billion of UK investors' money is in these LifeStrategy funds. The most popular being LifeStrategy 60, but 80 and 100 also vastly popular, largely because of the fees that you just mentioned, going down from 0.22 to 0.2%. It's a pretty good place to make a start, and it's a real mix of companies across the world. But what it is doing and what it has announced this week is a slight reduction in the home bias of the UK from these LifeStrategy funds, from 25%, so currently 25% UK exposure, down to 20%. And then when it comes to bonds and government debt and all that kind of thing that's in the other part of the yin and yang of this, it's going down from 35 to 20% as well. So both going to be at 20%. Now, I am a Vanguard customer. I do save in Vanguard, so I have an active interest in this, and kind of I helped Tanya crunch the numbers on this, because I was kind of interested in how much this would kind of fly in the face of the Chancellor, who of course has been saying, let's invest in the UK. It's been encouraging people to potentially invest more with the cut in the cash ISA allowance from 2027 for under 65s, and this whole drive towards us investing more into Britain. And then things like this happen, and you kind of, the Chancellor must put her head in her hands. It's not a huge amount in the grand scheme of things, though. If you think about it, £1.85 billion coming out of UK equities, but it's the kind of symbol of what that means. And I had a look in the comment section in here, largely people are seeing it as a positive move that actually is overweight in UK investments, and it's been a long time coming that this has been rebalanced. So someone pointed out that 25% UK exposure in LifeStrategy funds is very high indeed. I'd argue that 20% is too high. In an all-world funds, UK exposure is only 3 to 4%. So it is still quite heavily UK focused. 20% is quite a large amount. But if you are a Vanguard customer or whatever funds you have, you should go and have a look and see how the blend of and the makeup of your investments is. The other thing I should point out with Vanguard, it did make some changes at the start of last year. It charged a £4 monthly admin fee to investments worth up to 32 grand. And 0.15% up to a maximum of £375 a year. It was a little bit upsetting for people that started just with like single praises for, being a great place to start out. But unfortunately, that bit of a kick in the teeth.
I think it's very interesting. And one of the reasons why I think it's very interesting is I think that there'll be lots of our listeners who hold the LifeStrategy funds. There's a huge number of people who hold the LifeStrategy funds. They're very, very popular. They're popular for a reason, because they're dead simple and, you can spread your risk everywhere and so on. But I think there's lots of people, and I'm not saying our listeners will think this, but I'm saying there's lots of people out there who didn't even realise that their LifeStrategy fund was majorly skewed towards the UK. I think there's a lot of people out there who think that it is effectively a global tracker fund, and it isn't. It does have this, large weighting to the UK. And that does mean that in years gone by, the performance hasn't been as good as a global tracker fund, even if you held the 100% equities version. But obviously now this has been cut, but just at a point when the UK stock market is doing really well. So there might be some investors sitting there scratching their heads and wondering about all of this.
I was going to say, the other interesting part of this quickly, Georgie, is that it's launching a new set of LifeStrategy funds as well, LifeStrategy Global. And it's going to be a very similar concept that there's a 20, 40, 60, 80 and 100 version of this with a 0.2% fee. This is designed for investors who want to be fully invested across global markets with no extra weight given to the UK. That again is actually interesting because you might find people taking some of the money out of their current LifeStrategy funds and putting it into this more global one. That there's, given that there's been a spotlight shone on the fact that there is quite a UK bias on this LifeStrategy fund, as Simon says, that people might not have even realised. So it'll be well worth going and investigating where these global funds are going. It started from yesterday, so the details should be on its website.
The other thing to say is that if you are interested in this type of investment as well, then it's also worth looking at BlackRock's MyMap range, because it does a very similar thing. It's much less well known than LifeStrategy. I'm not saying either one of them is better, but it is worth looking at the BlackRock MyMap range. And these can be a very, very, very cheap way of investing. For example, you don't have to hold them through the Vanguard platform. You can hold them through another platform, and that other platform might charge you no fees at all.
That's it for part one.
I am joined now for our weekly Investing Explained feature by Blair Gashi of Charles Stanley Direct. Blair, we've got a question here from a listener. I want to build an investment portfolio and would like to hold individual shares in it. How many different shares do I need to diversify?
The first thing I like to do is give a bit of research and context, Talking about diversification and individual shares, this goes back to kind of modern portfolio theory. And modern portfolio theory shows that you don't need hundreds of holdings. In fact, the kind of nice number is around 20 to 30 shares. And that is essentially the amount you need to kind of essentially reduce company-specific risk. Beyond that point, any additional shares tend to make a very, very small difference in overall volatility. But I will say, just because you have 20 to 30 shares doesn't mean that diversification is kind of complete. There are other factors you need to think about as well as just as hitting a number. It's about variety, mixing companies from different industries and sectors and, exposure beyond just one region or market theme. Historically speaking and speaking to people in coaching calls, researching 20 to 30 companies can be a lot outside of, working hours and kind of family life in general. Which is why many people kind of do a core satellite approach, where the core is essentially the funds, where the kind of diversification is already embedded into it by choosing the stock selection and things like that. And then, the 20 to 30 holdings is something that they feel like they are interested in, and they'd like to fill any gaps if the stock or fund that they have is there.
Lauren, great advice. Thank you very much.
Thank you.
Welcome back. Britain's biggest building society has made a major change to its mortgage lending, meaning some customers could borrow £50,000 more. Nationwide will allow new and existing customers to borrow 6 times their annual earnings, up from 5.5 times previously. Now, generally, most banks limit most customers to 4.5 times their salary, so the change could open the door to buying a bigger or more expensive home. A step in the right direction, or the path to trouble, Lee? Give us the details.
I don't know if it's a path to trouble, Georgie. I think anything that encourages and helps first-time buyers get onto the property ladder is a good thing. Obviously, you have to factor in all of the kind of costs and everything involved, and just for even second buyers as well that want to get up the ladder, it's a relatively positive step, as long as you're not like everything in life, as long as you're not overstretching what you're doing and you can afford the monthly payments and you can do it. Now, I think this 4.5 times salary as a rule of thumb has been what we've used in stress tests in the last sort of 15 years or so, maybe even 20 years. There has been a nudge up in the last kind of year, with lots of the major lenders now going above that and allowing people to borrow more money in order to buy a home. So it means a couple earning 100 grand between them could now borrow £50,000 more, as you just said, up from 550 grand to 600,000 pounds. A single borrower on 75 grand would see their maximum loan rise from 412,500 pounds to 450 grand. So 37,500 pound uplift. If this helps the wheels in motion of the property market and get people buying and unlocking some of the market where people are perhaps getting stuck, or perhaps don't feel like they can quite stretch it, it's fine, as I say, but within reason. Lots of brokers, of course, have said that this is a positive step, but they've kind of got vested interest in this, and it's kind of, you think if these major lenders are doing it, my first thought process is, well, is it out of the goodness of their heart, or is it because they're going to make more money? And of course, money makes the world go round, and there is more money to be made by lenders who, people are stretching potentially. Again, a rule of thumb, I would say 15 years ago was a 25-year mortgage. That slowly went up to a 30-year mortgage, which has slowly gone up to a 35-year mortgage. Some people are taking out 40-year mortgages. You have to, like all of the information and the financial information that we have now in terms of calculators and figuring out how much interest you're going to be paying over the course of a home loan is vitally important, as are things like product fees when you go to buy a property, factoring all of that in. But my gut instinct, Georgie, is that this does feel like a positive step. People should know their finances. We've lived through the financial crisis. We saw a lot of that was involved in bad mortgages, people falling into negative equity. And I like to think that people have learned lessons. And if you haven't learned the lesson, your parents learned the lesson, or your grandparents learned the lesson. And you're not going to do silly things and completely overstretch what you can afford. But that's what these stress tests are for. This is what banks, they don't really want you to fall into trouble. They want you to be a nice customer, pay your monthly mortgage amount, and hopefully stay with them for life. That's their goal.
So I do love your optimism, though, Lee. To think that we learn from the past, please.
Yeah, I mean, yeah, okay. All right, maybe I stretched it a bit too far.
But I enjoy that nonetheless. Now, Simon had this look on his face that either, Simon, you've seen the latest breaking news about Donald Trump. I don't think there is any, but there might be. Or there's something that Lee said there that shocked you.
Well, were I to speak about the latest breaking news about Donald Trump on the podcast, it would be a mistake, because by the time you listen to the podcast, we get this out pretty quickly after we've recorded it. Probably going to have changed.
Yeah.
No, it was the 450 grand bit. That is a big mortgage to be taking out on your own. £75,000 income, 450 grand mortgage. Now, the thing is, though, it's not just about this income multiple. You're going to have to pass the affordability tests. And what you will find is that, Nationwide is a responsible lender. And so Nationwide is going to do the incomings and outgoings calculations to make sure that anybody who was on that 75 grand, for example, and getting that 450 grand mortgage, that they believe that it is affordable for them.
Mm-hmm.
But I just did some quick calculations. That is the equivalent post-tax of about £4,500 a month. But that obviously wouldn't take into account if someone was repaying their student loan, and then they would be getting less money, for example. Knock off, obviously, the fact that you need to be making some pension payments as well, for example. The mortgage, if you had that 450 grand mortgage over 35 years, so over a reasonably long term at 4.25%, which is a reasonably respectable rate, you might get it a bit lower. It's going to be £2,000 a month. £2,000 a month on £4,500 of post-tax income is a really big chunk of your post-tax income. But there will be people who are looking at that number and going, well, it's less than I'm paying on rent.
Yeah, quite. All right, Lee, just before we move on, do you think that this is the trajectory now? We're just going to see more and more of these?
Yeah, and it's been a kind of requirement. I think it's been very much encouraged by the Chancellor via the FCA to make sure that lenders are doing more to kind of loosen criteria and restrictions and get more people on the ladder. And I think that's Simon hit the nail on the head really there, because, a lot of people do feel like they're trapped in a rent cycle. And if they can afford rent, they can afford mortgage payments. It's getting that deposit and it's getting through those affordability checks and those lending checks. And, if you can afford rent, the argument is you can afford a mortgage. That's the thing. But a mortgage is obviously for a lot longer period and you are tied in, and it's a big commitment. So that's why I'm saying you really do have to crunch the figures. And that's where, potentially a broker might help you and might be worth he or she's weight in gold.
Absolutely. All right, if you have no idea whether you're saving enough to just scrape by or you'll enjoy a prosperous retirement, then you are far from alone. Many of us will be automatically opted into a string of work pensions, but have no clue whether these funds will actually deliver a decent income in old age. So this is Money Asked experts to crunch the numbers so you can see if you're on track for the retirement of your dreams at each decade of your life. So in your 20s, your 30s, your 40s, 50s, how much should we have?
This is a question that people absolutely love to ask, and it depends is the answer really. Okay, but firstly what you need to look at is what are you going to need in retirement. So if you look at the Pensions UK figures, the artist formerly known as the Pension Lifetime Savings Association, a single person needs an income of £31,700 a year for a decent retirement. This is a moderate lifestyle. Covers some essentials plus a bit of splashing out on food and entertainment, trips abroad and running a car. Couples would need a joint income of £43,900. The very minimum you need is less, £13,100 for an individual and £21,600 for a couple, while you need more for a more affluent lifestyle. They don't take into account income tax and housing costs if you still have a mortgage. Now, if you work from these numbers, you can work out on the moderate income what sort of pension pot you would need. And you would need a pension pot at the moment of around £325,000 by age 66 to be able to afford a moderate standard of living according to Standard Life. So if you take this and you work back to your target amount in your pension, in your 20s, right? Now bear in mind your 20s start obviously when you're 20 and end when you're 29. There's quite a big gap. There's quite a big gap between those. Just to state the bleeding obvious, right? Okay. You could be lower at the start, but you want to be higher at the end. Okay. Right. 20s target £11,000. Now this might seem a very modest amount, but retirement might also feel a very long way off when you're in your 20s. But the point is that you have started saving into your pension. You have begun the act of investing into a pension and taking advantage of compounding. Your ultimate goal is to save hundreds of thousands of pounds. You have to start somewhere. Starting in your 20s is a massive benefit. If you save for 40 years instead of 30 years, there is a wonderful trick involving compounding that means that you double your money at the end of it. And it's not due to the extra money you put in, it's due to the gains that you earn on gains, the snowball effect. So there you go. In your 30s, okay, I'm not going to do this for every decade, stating the bleeding obvious. So work it out for yourself how your 30s last. Yeah. For some people, their 30s last much longer than 9 years.
I was going to say, Simon, I've been 38 for ages.
Okay, well, I mean, chances are that you might have managed to get ahead of target then. The target is £55,000. Right, your salary's going up. Your savings into your pension are going up. You're benefiting from compounding. Hopefully, you are not stopping your pension payments or reducing them due to life getting more expensive as you might have a family, or try to buy a home, try to afford your £450,000 mortgage. Keep going. Make sure that you're not just putting in the auto-enrollment basic minimum, okay? Take maximum advantage, if you're employed, of what your employer will pay in. If they'll match what you pay in as much as you can to get the most that is possibly matched. If they'll do more than match it, do that as well. If you are a public sector worker and you benefit from a defined benefit pension, this is where your employer says that it will guarantee to pay you a certain amount in retirement for every year that you have worked for them. And it is infinitely better than the defined contribution pensions that most people in the private sector have. But a lot of people in the public sector don't fully appreciate how good their pension is. They are required usually to put in more money, okay, but their employer puts in way, way, way more than private sector employers do. And also, it's made a binding promise that it can only be broken if it goes bust, and even then your pension is protected. So if you are a public sector worker, you must take advantage of that pension and pay as much into that pension as is required to make the maximum use of it. So anyway, keep going. £55,000 in your 30s. In your 40s, this might be a decade that lasts longer than 9 years for me. Your target is £117,000. Okay, you're chipping away here. You're on track for your 325 grand. In your 50s, your target is £201,000. This is your mid 50s. Okay, this is where you're trying to get to. And then finally, obviously, by the time you'll get to 66, hopefully you're going to hit that £325,000 number. Obviously, what you need to bear in mind is that depending on how old you are, by the time you're 66, £325,000 is not going to be worth £325,000 as it is now. It's probably going to have been eroded by inflation, and you're going to need a larger pot than that. Don't sit back on your laurels. Keep going. Make sure that you get that retirement that you want.
Absolutely right. And I will say that in my 20s, I'm afraid I didn't hit that. My 20s felt like forever. I didn't hit that target, but you can make it up. Lee, but what should you do if you are off target, as it were?
Well, first of all, don't panic. Don't think that it's impossible sums of money that we're talking about here. And actually, but it's a bit similar to you, Georgie. I didn't really start seriously paying and saving into my pension until my late 20s. I would say I had a pension and I was paying the bare minimum into it. But as Simon pointed out, you're potentially saving for a house deposit. Rent was expensive. Everything was expensive. Life is expensive. And you kind of, in your 20s, retirement, it just feels so far away. But I have made it up. And I've made it up with gusto, I would say. Now racing, I'm still in my 30s. I'm in my late 30s.
Yeah.
But the last 10 years of taking it a bit more seriously. And I would say, if you are lucky enough to get a pay increase, for example, I always think it's worth bumping up your pension contribution by 1%, because you're probably not really going to notice it. And checking out what your employer offers. Are they matching your contributions, or are they doubling your contributions, or offering something else? But get on with it and go for it. And on this podcast, I quite often say, I quite often big up regular savings accounts as a starting point for people who aren't in the savings habit. In a similar way for pension habit, even if you start small and you're not putting in huge amounts of money, it soon starts to build up over the years. And you want to be in control of your retirement. And again, as we say in this podcast quite a lot, if you're self-employed, the importance of having a SIP. And making sure that you're not missing out. I would say, how much do you need for a comfortable retirement? I think these figures are actually undercooking it a little bit. I actually think you should probably aim for a bit higher than this, if I'm being quite frank. Of course, we've got, hopefully, we'll have a state pension to fall back on. But, the age of that has been pushed back and could potentially be pushed back further. So if you're a listener in their 20s, 30s, especially, what age is going to be the state pension age? Have you you're going to have gaps in your national insurance record, all of that kind of thing. It is important to give it some thought. And again, like the mortgage story we were just speaking about, crunch the sums. A lot of your pension providers will give you forecasts of where you're at, and if you make a little tinker of a percent, how much more that might mean in retirement. Compounding is your friend. You want to make sure that you're in control of your retirement. You do not want to be trying to make it up in your 50s onwards. I think it starts to become very difficult to catch up. So earlier the better. Even if it starts small, start growing it, seeing that get into 4 figures, then 5 figures, and then hopefully eventually 6 figures. It becomes a bit addictive, I would say.
Yeah, no, I agree.
Checking in on your pension every sort of 3 to 6 months, going, oh, do you know what? Yeah, no, this is looking all right. Stay optimistic.
Yeah, no, I agree with you. I think it's motivational, isn't it, Lee? And all I'll say to anyone who thinks, oh, that's years away. We've been doing this podcast for 12 years. Wow, where did that time go? And it does. As every old person will tell you, time goes so quickly, but it does. And you'll be so grateful in 12 years' time when you look back and go, wow, that went like a flash, but look how much I've got in my pension.
2 very quick things on the pensions is, firstly, if you are auto-enrolled, check, and you're an employee, check that you've been auto-enrolled into the best pension scheme that your company would offer you. Sometimes you get auto-enrolled into the basic auto-enrollment amounts rather than the more generous scheme that your company may offer you, and you might be passing up free money there. So check which pension scheme you're in. And then secondly, obviously, unfortunately, we've been talking lots about people who are employed here, but the self-employed people, unfortunately, this is all on you. I'm sorry, but it is. You've got to do this. There's some debate as to how you should do it, whether, because obviously income is lumpy. My suggestion would be open a self-invested personal pension and then set up a certain amount every month to go into it, okay, by direct debit. So you're doing it regularly. So it's a habit amount. Now, that might not be the full amount that you put into your pension, but at least it means you've got a base level amount going in every month, right? And then when you do have the good months, rather than the bad months, so you have some extra money left over, or perhaps, for example, this is something my wife does who's self-employed, she puts money into another account to cover her tax bill at the end of the year, but she's cautious on that, so she puts in more than the tax bill is going to be. If you end up with a bit left in that tax account at the end of the year, shove it into your pension. But I do think it's worth doing that regular monthly amount, just so there's a base level going in, and then maybe you then top it up yourself.
Good advice there, Simon, and I say that as someone who's self-employed. Finally, the phone for billionaires. Virtue? Who knows? Because I'm not going to be spending £5,000 on a phone. But apparently it has an AI concierge which can book you a private yacht. Does it pay for the private yacht as well? But is it worth it? The team went to find out. Lee, there is no story too random that you won't look at. Is it Virtue?
I think it's Virtue, and I think that random. We like a bit of random. We like to mix it up. We like to get out there and see what's happening in the world. And sometimes these things just sort of land on us as editors. We're like, "You've done what?" So Harvey Dorset, one of our reporters, got his hands on a Virtue Agent Q phone that starts from £4,930. It has a leather back. And I held it in my hand, and it was the weight of a brick. It was incredibly heavy. Very, very, very unusual looking phone.
So far, you're not selling it to me, because I don't really need a brick in my handbag. I've got enough rubbish in my handbag, and a leather bag that can get scratched.
Yeah, it's a heavy piece. It's a heavy piece, Georgie, I would say, to be carrying around. So Virtue traces its origins in England in 1998, and it became the it phone of the noughties. So it was reportedly owned by Gwyneth Paltrow, David Beckham, Colleen Rooney. We weren't able to ask David Beckham this week if he actually did have one of these phones. He's been a bit busy apparently. Yeah. It went out of business in 2017, and its factory in Hampshire closed down. And then in 2018, it's launched under a new ownership. It's now HQ's in Hong Kong, and it says there's a big demand for these phones in Asia and the Middle East. Now, what it is, the kind of 2 big selling points of this is there's something called Agent Q on this phone, which is a built-in AI concierge. So I guess the idea is if you are uber wealthy, instead of keep pestering your PA to go and book your flights and do this and do that, the phone can just do it for you. Now, Harvey says that he asked for it to book a restaurant for him. The restaurant he knew was fully booked, to see if, having this phone might help him jump the queue. It didn't. He didn't manage to get
Rubbish.
that. And as you say, it can book you things like yachts and helicopters, but you still got to pay the bill for that. So unfortunately, Harvey didn't get to test that bit to see if he could book a yacht sailing around Canvey Island or wherever you'd sail in England. I'm not sure where. The other thing that it has is this kind of like encryption vaults. They liken it to an impenetrable fortress. So basically just keeping all of your messages and everything secure. Would I pay £5,000 for a phone? Well, Georgie, I'm going to be honest, my next phone might very well be a dumb phone. I think I'm done with smartphones. I think I'm kind of hankering back to just a phone that you can make telephone calls with and send text messages. And I'm going to end it with this. The other night, my 7-year-old has become very interested in Newsround, which I really like that. It's very wholesome sometimes, but sometimes some of the news is like...
I was going to say, what news do they put on there?
Yeah. Well, this week it obviously very Donald Trump heavy. So she asked me the other night, is Donald Trump a good guy or a bad guy? I mean, that's a loaded one, isn't it? Then it went on to why are they trying to get Greenland? And then the conversation went on to the Empire and all sorts of stuff you can't imagine. But the other big story that they've been talking about on Newsround this week that my daughter's picked up on is the social media ban potentially for under 16s. Obviously, it's happened in Australia. There's talks about it happening here. And I said, well, she said, I think it's a good thing. Not that she really knows what social media is.
I was going to say.
And not that she uses the phone. And I kind of agreed. And I said, yeah, I might get a dumb phone. Now, what got me with this is that she knew what a dumb phone was because they've been talking about it at school. And teachers saying that dumb phones are kind of like the preferred option if you are going to pack your child. I'm not talking my daughter's age group, but probably like year 5, year 6, dumb phones. I actually think that is more likely where people are going to head next rather than spending, giant amounts of money on a phone. I get the impression that there's a bit of a kind of people getting fed up of their smartphones, but maybe I'm wrong.
And finally, before we get Simon's stat of the week, Lee has been hobnobbing with his celeb friends again. Lee, who have you been talking to this time?
I interviewed Joanna Page, otherwise known as Stacey, out of Gavin and Stacey, and she was an incredibly open book when it comes to her finances. You can read the interview on This Is Money. You'll find it on there. It was published over the weekend. Been very well read this week. We bonded very much, actually. Do you know what? We bonded actually quite a bit over mobile phones because she was refusing to give her children mobile phones.
There you go.
And also, I mentioned that my wife is from just outside of Billericay. And when I first met her, because obviously that's where a large part of Gavin and Stacey is filmed. And when I first met her, she actually drove a blue Saxo, just like Gavin in Gavin and Stacey. So she absolutely loved that. You can listen to a little snippet of our interview coming up. As I say, she was great value. She was very, very open on her finances, and it was thoroughly enjoyable.
Well, it was my mum and my nan who really taught me about money and talked about it and made it seem not such a scary subject. My nan didn't have any money at all, but she was very much spend a little, save a little. She had to save quite a lot. And so I was brought up knowing that, well, yeah, make sure that you save, make sure that you're stable and you look after yourself and you're secure, because it's just going to be you looking after yourself. And then growing up, mum straight away said, even when I was about 7 or 8 years old, we opened a little post office account, and any birthday money I had, it would always be like, right, okay, you can go and buy yourself a little toy, and then the rest then we're going to put into a little savings account for you. If you don't have the money for it, you don't buy it. That's really informed the way that I am now, because I don't have a lot of credit cards. So I very much am of the mindset of if you don't have the money to buy it, you don't buy it. Save up and then you can buy it. When I was younger and I first got married and we didn't have any children, all of our spare sort of money that we had then, we would definitely invest in things. We invested in property, little different flats in London and down in Wales. Me and my husband have then had very much the same mindset of just make sure that you're safe, because I think he's from Bradford, I'm from Swansea, and moving from those areas, moving all the way to London, you don't have any family around you, there's no safety net. Obviously, my parents, would always be there for me, but the reality is, I'm 21 years old, living in London, I'm earning my own money, and if you don't save it or invest it and put it into a mortgage or buying your first property, well, you're not going to be able to look after yourself, are you? And you're not going to be safe. So I've been brought up like that from a very early age. When I first left drama school, there were lots of different people who were helping to pay for me to go through RADA. We wrote loads of letters and I was sponsored by lots of different people and companies. So we were very lucky there. But when I left RADA and I was 21, I remember my first ever job was at the Royal National Theatre and I was earning £250 a week. And that was the first time ever that I was properly earning my own money. And it was so exciting. But then as an actress, it's unpredictable. You're self-employed, it's unpredictable. You don't know what job's coming next. I remember when I was out of work for about a year, I was thinking, right, okay, start spending your savings, what you've got, the stuff that you've kept there, to make sure that you're going to be safe. And after a while, I thought, oh, this is ridiculous. And it's really bad for my mind as well. I need to get out there. I went straight away to go and work in a shoe shop, did an interview straight away. They hired me straight away. And that's where I started working. I mean, as an actress, so you don't know what's going to happen from one minute to the next. James and I were doing incredibly well the year that we were going to get married. I was doing The Casalets, which was a BBC costume drama, and I was signed up to do a second series on that. We had 4 TV shows that we were all set to go for second series. We bought our house, and that's been our main, it was our main investment that we did together, and all of our money went into buying a house in Dulwich in London. And we thought, right, okay, we've got some security. We've got 4 shows. We moved it, I think, in this September. By the next year, all 4 shows had been axed. So suddenly it was just absolutely terrifying, thinking, right, okay, we've got to scrape through. What are we going to do? I went out and got myself a job straight away in a shop. He then started doing voiceovers, which he'd never ever done before. And he now does so many voiceovers. He's fantastic at them. But we knew straight away that, okay, the main thing, which is our career, that's not working at the moment. We've got to start thinking, what are our side hustles? What are our passion projects? We've got to start thinking about other things aside from the main thing that we're doing now. And so, I went out, started working in the shop. He started going into doing his voiceovers. That's what we had to do. And we managed to make it work, bring in enough money to tide us over. And then luckily then we started getting acting jobs again then.
There you go. That was Lee speaking to Joanna Page from Gavin and Stacey. You can read the full interview on the This Is Money website. Simon, now for your stat of the week.
0.16%. That is the rate that you could be earning on Econo Bank's Easy Saver account, which was number 1 in our 100 worst savings account article this week by our savings expert, Sylvia Morris. It goes without saying that if you have one of these accounts and you have any money in it, you should move it somewhere else. And you can find the best place to move it to by going to thisismoney.co.uk/save, where there will be a host of easy access accounts paying more than 4% that you can swap your money into.
Wow. Just why bother? Do you know what I mean? Why bother with the admin of an account like that? Anyway, that is it. Thank you very much, Simon. Thank you very much, Lee. Thank you for listening. You can keep up to date with all the latest breaking money news. Just go to thisismoney.co.uk or download the app. And if you have any comments or questions for the team or anything you'd like them to look into, Simon?
Email us at podcast@thisismoney.co.uk, or you can come to thisismoney.co.uk/podcast to join in the debate in reader comments.
And if you like our podcast, why not rate us wherever you found us? It helps other people find us too.